Today, we sit down with Dave Kotter, who is the founder of the Hybrid Debt Fund, and they focus on closing that gap between LP capital and agency debt. He's focused on helping investors get the debt they need to do their deals without taking away all the equity that's necessary. So if you are interested in getting 80 to 90% of your loan to cost done while still retaining the majority of equity, this is a conversation you don't want to miss. And if you're interested in launching your own fund, well, he tells us more on how to do that as well. Make sure you check out today's conversation with Dave Kotter right here on Multifamily Insights. You probably got interested in real estate for the cash flow, the tax advantages, the equity appreciation, and the long-term wealth creation, not for the 2 a.m. emergency maintenance calls. But let's face it, maintenance can be the biggest headache when it comes to building up your real estate portfolio. And that's why I want to tell you about a new property management software called Hemlane. See, Hemlane is more than your typical software. It's really like having a property management support system. First, Hemlane provides 24/7 repair coordination. They have a network of vetted maintenance technicians and professionals in your area to handle repair and maintenance your property may need. Second, Hemlane helps you advertise your listings and even connects you to licensed agents to help find and place tenants. And third, Hemlane is ranked #1 by Gartner with an average of 4.8 star reviews on repair coordination. Learn how Hemlane can help you manage your properties with 100% transparency and control without the administrative work. And as a Multifamily Insights listener, you will receive 25% off for 2 months when you sign up. Just go to hemlane.com, that's HEMLANE.com, and use Multifamily Podcast 25 as the promo code. Again, that's hemlane.com, or just click the link in the show notes. Now, Dave Kotter is the CEO and president of the Hybrid Debt Fund, as well as Integrity Capital LLC. Now, at Integrity Capital, they focus on proactive commercial finance services for clients throughout the United States. Loan or equity parameters are 30 to 300 million, and they have funded over 2 billion to date. Let's welcome to the show, Dave Kotter.
Hey, thanks for having me, John. It's a pleasure to be here.
Yeah, absolutely, Dave. Great to have you on the show. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, absolutely. Yeah, so I started in the business. This was back when I was in ASU. I was a junior and decided that I wanted to take a foray into the commercial real estate lending space, and actually started buying and selling commercial real estate loans from banks all over the country, which was something I had no idea what it was about. And did that for a couple of years, and then launched Integrity Capital back in '03, so June of '03, and rode that thing up until 2008. And then 2008 happened when the whole world stopped, and got a lot of lessons there. So I funded over about 500 deals, done essentially about 2.1 billion of fundings over the period of time, done it for 21 years. And have dealt with a lot of multifamily people throughout the years on equity and debt as well. So and we're obviously launched Hybrid Debt Fund a couple of years ago, which is a direct private credit, high leverage commercial real estate product that we're currently raising and deploying for throughout the United States. We do 5 to 15 million in size, and we do what's called the stretch senior loans. So we go up to 80 to 90% loan to cost for projects. And then we end up actually taking a participation with the developer. So we're almost kind of a partner, but we're not in their limited partnership. And so it's a bit of a niche and unique product that could be helpful for some of the listeners.
Yeah, man, great to hear. So, I heard you talk about kind of your background, really got into kind of the buying loan space, did that for, a couple of decades and really, had some success there. And more recently, you got into this hybrid debt fund where you focus on opportunities for investors, where you're really taking these high leverage positions and partnering with them to help get these deals funded. Let's kind of unpack that a bit because, for folks who aren't into this space, that sounds like just a lot of words, right? And don't
It
know
is.
what that
Yeah.
means. So
Yeah.
when we talk about one, high leverage, and you mentioned 80, 90% LTC, let's just strip that down, man. Let's talk
Yeah.
about what that means, that it's kind of core.
Yep. let me unpack it, and I'll do it in a way that is almost a real specific situation. So let's say one
Yes.
of your listeners is buying a $5 million apartment complex, and they're going to rehab it. And they have a couple of choices. They can walk into the bank and they can get their 60% loan, and then they can go syndicate the rest of the money. Or they can do a private lender, maybe it's a little bit higher, syndicate the rest of the money. In this particular situation, on that $5 million deal, what we would do that would be different would be we would still play that position of the lender. So we would take that first deed of trust. The difference is we wouldn't go to 60, 65, 70, 75. We can go all the way up to 80, 85, 90%, as long as it never exceeds what we considered 80% of the future value, that the value that they create on it. And so the benefit to the syndicator on the multifamily side is that they don't have to go raise as much capital. In fact, they might already have 10 or 15% in themselves. So they get to not have to give up as much away to the people that are investing in their project. So that's the first benefit, is that higher leverage allows them to have to not raise as much equity, essentially. The second benefit is that we end up doing a fixed rate loan. So today we're probably somewhere in the 7.5 to 8.5, depending on the deal. You don't have floating rates. I think anybody in the apartment world, depending on where they were at when we had floating rates, and all of a sudden the interest rates the interest reserve burned out. It's pretty scary, right? And now they're like, oh crap, what do I do? Well, this is fixed, so we don't have that floating rate SOFR issue. So that's the other benefit of this. The other component is that we do a 3-year note, so it's interest only. And what happens is we end up, because we're taking that additional risk with them, so we're kind of going a little bit higher on the stack. We say to them, look, we're not going to be in your limited partnership. So you have your own LP structure that you set up. You are a GP, you probably set up your LP structure. We're not in your entity at all. So it feels like a partner, but we're not, because we are not in there. Where the partnership comes in is that we take an additional interest carry. So what happens is we'll take 30 or 35% of the profit on that particular net, call it net cash flow when it does cash flow. And then we take 30 to 35% of the reversion. So when that syndicator gets to the period where they're going, okay, I'm ready to sell, and I'm going to sell this project, what happens is they sell it for, again, let's just say they sell it for $7 million. They pay off their loan. Okay, so let's just say we lent them $4 million for the sake of discussion. They pay off the $4 million. They pay the fees to the broker, and then we just split 70-30, right? That's it. It's very simple. There's not waterfalls. It's not kind of complicated math. So it happens on the net cash flow, and it also happens on that moment of reversion. And so they get the benefit again of doing their whole project. They get to make their decisions on their own. They don't have a partner that's kind of coming in and doing that. And they get the benefit of ultimately selling and doing the same thing. They probably get to keep more of the profit than they would if they have 10 or 15% into the deal. So that's the sort of the impetus of the product and the program. And the blessing is they don't have the partner. They get to keep the depreciation. So that's theirs because we're not in there. So these are all the natural benefits of the program and what it would look like for somebody walking in and why they would want to do it versus the other one. So that's the nice part. The challenge is right now is that, projects are kind of tricky. And so there has to be enough margin for us to say yes. Just because we're taking that additional risk, that person has to be able to say, okay, if I'm building this thing and I know the cap rate is 6, let's just say, and I'm going to build it to about a 7.5, that's probably where we come in. If there's 150 basis point spread between that, call it that exit cap rate and what they believe they can build it at, then that's where we come in. So there just has to be enough margin in the deal. So I'll stop there. Hopefully that wasn't too overwhelming.
Yeah. So, Dave, I mean, what I heard is a couple things, right? So, for our listeners who are more used to maybe traditional JV approaches or a 70/30 syndication model. What you're talking about is this is maybe an alternative solution where for that operator, that investor, you can come in, have a partnership with this hybrid debt fund. You're doing that
Mhm.
first position lien as far as the note holder. So you're going to do the main senior loan. But on top of that, they're going to go up on the leverage. So you can go up to 80, 85, 90% LTC.
Mhm.
So you can get a large chunk of your capital right there. And that
Yep.
allows you to retain more upside than what you're saying on the back end. Yes, you're going to take about 30 to 35% of the cash flow, 30 to
Mhm.
35% of what you call the reversion, but really on the exit there. But again, that's actually less than what you would typically give up if you're a sponsor or an operator. That's less than what you would give up to LPs in a deal, right? Typically, again, you're going to see 70/30 the other way, where 70% of the
Yep.
profits are going to the limited partners and only 30% going to the general partners. So you can get a sense of why this may be attractive for
Yeah.
general partners and operators. Uh, on this deal, you did mention that, hey, there's got to be a spread, right? If there's
Yep.
not 150%, 50 basis point spread in the cap rate, then there just
Mhm.
may not be as much upside.
Yeah.
Saying that same thing differently, what I'm hearing you say is there has to be enough value being created
Yeah.
where the numbers are going to pan out. Because if this is if this is a call it a light value add or a small value add, or you're going to push rents, $25, there doesn't seem to be enough
Yeah.
value being created where the numbers will work out where you all want to be involved. Is that a fair way to articulate what you said?
Absolutely. I would say we look at two primary things. The first one is the sponsor. So if they're new and doing it for the first time or even the second time, it's probably not a fit because we really want to deal with people that, again, the way we look at it is you've gone full cycle a couple of times, two or three times at least. You know your backyard, meaning you've let's just say you focus on some area in North Carolina, or maybe it's little areas in Georgia and Florida or whatever. Like you know your backyard, right? Like you know those streets, you know the submarkets. So we're looking for that person that just they know it. And then I would say they also have to be financially sound and strong. We look at 10 to 15% liquidity typically of the loan amount that needs to be in tow. And so that's kind of the first criterion that we look at is like, are you an expert? You know your craft, you know your backyard, and you're financially strong. And then the second thing is, to your point, is yeah, what's this value creation that you're making that justifies that there's enough room for what I call error, because every deal has its own set of issues, right? And so we just need to know that there's enough cushion there that, when things don't go the way that we anticipate, that we're not just so razor thin that it's like you make one mistake and the profit's gone. And so those are the kinds of things, those are probably the two major things we look at to just sort of have our lick test. And we use a tangible one of saying 150 basis point spread, which isn't the easiest thing to do on multifamily. It tends to be a little more stable, and so there's not as much inefficiencies, but there can be, and we have seen it. So hopefully that makes sense.
Yeah. What's the origin of this? Like, what made you
Yeah,
decide this was needed and you wanted to create it?
yeah. Well, first of all, I wish I was the smart guy in the world that came up with this concept, and I'm not. It's like my pastor always says, I'm in the R&D business, rip off and duplicate, right? So, the idea is I represent and have for years, life insurance companies, CMBS, a bunch of different groups. There is a life company. There's a couple life companies. There's not a lot, I'll say that, but there's a few of them that do what's called participating mortgages. And it's been around for 40 years. That's the nice part. This is, nothing new under the sun. It's been around, it's proven, it works. There's lots of deployment on it. And when I tasted this and we started originating on it, I was like, this is awesome. I mean, you get a first deed of trust, you get a guarantee, they get higher leverage, you get a fixed rate, like everything checked the box for me in terms of the benefit of the sponsor, the borrower, the syndicator, and then also that investor, right? They get the benefit of like, oh, I get a deed of trust and I get fixed income, but I also get upside and I don't have to take the equity risk. So it just sort of checked a lot of my own boxes because I've been around the block long enough to kind of go, and that was unique. It's different. It's distinct. We didn't want to just be a hard money lender. So we wanted to have something more institutional grade, something that we really felt like we could add a ton of value. And it was different. And so that just when we spent 6 months looking and kicking around and trying and thinking, I have one of those annoying minds that's always sort of tinkering around and like, it's got to be unique and distinct or I'm not excited about it. So as soon as that came up, I just went, oh my gosh, I love this. And I actually went back to the life company. I said, hey, I'm kind of an open book guy. It was like, I want to do this myself, but I won't do it unless I get your blessing. And they said, yeah, just don't take our loan documents, right? I said, no, I wouldn't do that. So that was kind of the genesis of the whole thing. And it's been a lot of fun trying to figure out how this works for both sides of the coin.
So on your end to create this, right? You had the look behind the curtain. You're doing
Mm-hmm.
this for these life insurance companies on that end, right? They gave you the blessing to go ahead and do this.
Yep.
What does this look like rolling it out? Like, do you start with, okay, I'm gonna do a $10 million fund? Is it a
Yeah.
certain dollar amount? Did you already have
Yeah.
clients? Do you have the capital? Do you have to raise the capital?
Yeah.
Like, how do you pull all this together?
Yeah, it's a great question, and it's one that as I've gone through it, it's I've stepped back and said, somebody's got to do this a little bit better and have a better framework for how you do a fund. Just because it's a really weird world where there's a lot of hands sticking out wanting money with just no delivery. There's tons of managing broker dealers out there, and you could spend so much money trying to raise a fund and just kill yourself. And so the starting place for us really was what the big problem we wanted to solve. So it was just making sure we felt comfortable with it. And the second step for us, and it's kind of the way my mind works. My life's on a spreadsheet. It's funny when I was getting married, my buddy says, "You can't. The marriage doesn't work on a spreadsheet." You realize that, right? I'm like, "Yeah, you're right." So basically, we just started modeling it out. And it took literally about 140 different iterations of it to really say, how does this work? Because I would start modeling it and I go, that's not going to work. And it just took a lot of just kicking it around and modeling it. And then we spent a pretty decent amount of time talking to people and just asking them, going, what do you think? Is there a market for this? Would you use it? I was just at we have a nonprofit called H3 Phoenix. It's a leadership development thing. We had a guy speak and he said, when I started my software program, which was education oriented, he said, I went to every single, um, kind of superintendent in the Valley. And I told them about my idea. I said, I don't have anything at all, but if I could make this, would you sign an LOI right now? And he literally got all these LOIs signed up and then he went and built it, right? So I thought, what a brilliant idea. Uh, but the same thing in the sense, just interviewing people, talking, listening, and making sure that there was a market on both sides of the coin was really the first thing we went through in order to really say, is this going to be absorbed? And what we found out was pretty quickly is there's no small market for this at all.
Mm.
Everybody was like, yeah, there's just huge demand, no supply. We were like, that's cool. And then the second piece of it was on the investment side, raising money is really, really hard, especially now. And so if you walk in and you have the same kind of thing, it's private credit, and everybody's like, yeah, you and every Tom, Dick, and Harry. And so when we came in with this, everybody was kind of scratching their head and went, huh, I've never heard of that before, right? So it was one of those things of just testing and making sure you could get traction on both sides of it to make sure the investment is there. And then really the fundraising is just spending time really saying, how are you going to get the return appropriated? And then we have the hardest job because we're a first time fund, right? We're doing $50 million and it's super hard because you're trying to get people to do your first time thing. Thankfully we've gotten traction, but it's it's really hard to do your first. I don't care who you are, even if you're KKR with a new fund, it's super hard. So I think just you have to really understand what you're doing different, and you've got to be able to show you got a market for it. And then you have to show that you've got clients, which thankfully we do, that would do this. And so it's kind of you're playing both of those parodies, in order to show somebody, well, if I give you the money, can you deploy it? Uh, so hopefully that makes sense. But that's kind of how we've gotten to where we are.
Yeah, I think it's really helpful. And I want to separate the conversation for a second because I want to come back. You hit on a few different things, right? I'm going to put a pin in the conversation for the sponsors and
Yeah.
operators and kind of the benefits and what they're going to get. And I want to focus more on kind of what you were doing, right? Creating the fund, raising the
Mhm.
funds for this fund, and to your point, the challenge of getting people on board as a first time fund operator. And hey, even if I do give you the funds, will you have the ability to deploy these funds, right?
Right.
Because it sounds crazy for those of us who don't have just, tens or hundreds of millions of dollars sitting in our bank accounts. But the reality is, when you have those kind of funds, you have to deploy them, right? Like it's a problem to be solved. It's a good problem, but it's still a problem to be
It
solved.
is.
And them giving you $20 million to just sit there helps no one.
Nope.
So that's something you've got to prove out as well. And I know one of the biggest challenges when it comes to raising capital, as you started to allude to, is getting people to believe in you and to trust. And a lot of times
Yeah.
the offering is very similar to what everyone else has in the market or what others have. And I've talked to a number of people who have created funds specifically for raising capital for multifamily. And many of them at this point have actually closed those funds because they spent 15, $20,000 getting the fund open and they didn't have the demand that they anticipated when
Yeah.
they launched that fund. Can you just talk a little bit more about maybe some of the challenges or some of the gaps that you
Yeah.
noticed from that standpoint?
Yeah. Yeah. A lot. I would say the core things were, um, you try to learn as you go here, but really saying to yourself, okay, what is the channel? Okay, that's the first thing. Like, what's the channel that I'm going to go down? Because in the fundraising, you kind of either go like the MBD route, managing broker dealers. Um, Nothing against them, super expensive. Like, just for us, I mean, we started modeling it and I'm like 10, 12 points. It's like, ouch.
Wow.
You're paying a lot to get money in. So for us, and a lot of people do it because you can get money fast. But for us, we just didn't feel right because I'm like, I'm gonna basically start at 88 cents, have to book it at a dollar and make up that difference to get a return. It just felt like we were too much in the hole. So that one was, if you got to pick the channel, then we said, well, what's the other one? RIAs, registered investment advisors. That's a whole different channel, that takes longer but can be fruitful and it's less expensive. You don't have to pay as much in fees. And then family offices is another channel, or ultra high net worth, right? Those are kind of the major food groups, or again, just family and friends, which is usually all the starting place. So I would say, like, really understanding the channels and then picking the one that you really go, this is where I think we're going to have the most success. For us, it was family offices and RIAs. And specifically, family offices are more of a short term, even though we would be with them for a long time. But it's something you can get quicker, and RIAs take longer because there's more compliance and you have to jump through hoops. So it's just putting that hat on to realize you're going to have some time of getting educated as to like what channel do you want to pick, and you got to pick one, because they're all different. That's what I would say to anybody doing it. The second thing is the GP. So how are you going to fund the operations of your organization? And I'll go back to everything starts with numbers. You got to model things out and you got to have your assumptions and you've got to give you some time to really think through and poke holes and have somebody look at it. Once you really understand that, then you know what you need to do to go raise GP money. And typically speaking, unless you're a wizard, it's going to happen through people you probably know and that trust you because it's the highest risk thing you're going to do. Basically, you have people that came in and I'm like, look, these are my assumptions. I think they're going to go well, but they may not. I don't know. But there's just a lot of trust that people come into your GP. So it's really getting, and that took I had a lot of convincing, right, to get people to come into the GP, and we're doing well, but that's the riskiest part for them. So I think so that would be the other challenge. Those are some of the other challenges, and then really getting your arms around this legal world. I would tell people be really a good consumer of talking to a lot of people before you pull the trigger with paying for legal fees and all these other fees. You can get legal for a lot less than you think you can, and it's pretty boilerplate because people can blow a lot of money really fast. I mean, I interviewed 10. They were like, 100, 150K. And I'm like, I'm not going to pay that kind of money. That's crazy. And so we were able to get it for more like 30, 35, so yeah, those are some of the challenges, I guess, and many more.
Well, I think it's really helpful to hear you talk about it because there are a lot of similarities to raising capital for a syndication deal, right? Or any other JV deal,
Yeah.
because you're talking about, and I think this is universal. So that's why I want to just play back. First thing you said was
Yeah.
your channel, right? And, I wrote down channel slash target audience, but like, who is actually
Hmm.
going to invest with you? Like, are
Yep.
they family offices? Is it, in your case, RIAs? Is it going to be ultra high net worth individuals? Uh,
Hmm.
who is your investor, right? Who is going to believe in your opportunity and fund the deals, right? You've got to make sure you understand that and be honest. Do you have a relationship with them? What kind of
Yeah.
returns are they going to expect? What time frame or time horizon do they have for these investments? Make sure it lines up because if it doesn't, you're going to have a hard time making this work. And I can't tell you the amount of times I've talked to, clients or new investors and they tell me that their target audience is doctors and they have zero ties to the medical profession. I'm like,
Yep.
we get it. We all know doctors make more money than most other professions, but that doesn't mean they're going to trust you and want to invest
Yeah.
with you. So,
Yeah.
it's one of those things where it's like, hey, make sure you actually understand how to navigate in that world if you're going to target that audience. The second thing you talked about was on the GP side, which
Hmm.
is again the dollars you got to bring to the table
Yeah.
because the truth is everyone wants to see you have skin in the game. And it
Yep.
doesn't have to be all your money necessarily,
Yeah.
but they do want to see that, hey, I'll put up a big chunk. You're gonna have to bring something to the table here. I don't care if it's you, your mom, your cousin, your uncle,
Mhm.
but you and your friends and family, you're gonna have to bring something to the table here to
Oh, yeah.
make us comfortable. And that's something that just can't be underscored enough because ultimately you want to earn trust, but that trust is going to be based on whatever skin you have in a game. And it's not always money and financials. It could be reputation, right?
Yeah.
Because yeah, you could get someone close to write a check, but most of us, you get to a point where your reputation, the time you spent, the relationships you've built up, that's more important than the $50,000 that I put in this. I can go make the $50,000 back. It's gonna be much harder to repair a reputation that you spent 5, 6, 7, 10 years building up. So
Yeah.
those are the kind of things that are important as well as investors.
So true. Yeah.
Now,
It's very true.
I wanna hit on one other thing, right? So when you talked about this hybrid fund, the hybrid debt fund,
Mm.
you mentioned that you were looking at, you didn't want to do hard money and some of these other
Yeah.
options. Can you just talk about really the landscape? Because I guess from my view,
Yeah.
if you want to be, let's call it a lender, right? I mean,
Hmm.
you could go hard money, you could do, private loans, you could just do first position or second position loans. What was it about this hybrid model that was so compelling as
Hmm.
opposed to one of the other more common existing models that are out there?
Yeah. It's a great question. I would say a couple of things. One is, when you're trying to make a decision and what you're going to allocate your priority to, because, like one of my mentors always said, you can't manage time. People say time management. You really can't manage time. It just goes by. Just manage priorities. So, what are you going to prioritize in that whole concept? And so, when you look at your allocation of priority to say, where am I going to allocate the same allocation of time that I do have to whatever this initiative is, you want to be able to jump into something that you feel is moving in the right direction, is a large enough market and that has a trajectory that is, where the puck is going to go. And so that's one of the decision points for me, is always to step back when I'm doing businesses and go, it's kind of like a tsunami, like be on top of it, just don't be on the beach. And so $2.1 trillion market, private credit is. It's going to move up to $3 trillion in the next, probably 5 years. And you look at the landscape of lending. So banks used to be the big foray, right? You had 15,000 banks, probably 20 years ago. Now we're down to like 4,000. And that world is shrinking. That world is closing in because of the distinction of extinction, I almost say, of just the way that they operate. And so you look at the landscape of, life insurance companies that are just kind of pretty steady Eddie, agency financing, which is really government backed, at least for now, that takes a huge chunk of the market. You look at CMBS, it's the secondary market. But private credit is this huge tsunami that's coming in because there's not as much regulatory issues, and you really can do some more creative things and move quicker, not have as much red tape. All that to say is, I looked at it and said, personality wise, and some of that is a decision you make, is like, what's my personality and my values? And my personality is, I really like to have something that's different. In the conversation, I want it to be different. That's just me personally, right? It's always kind of been that way. So when I looked at hard money, I just said, there's tons of hard money lenders, and they're great. There's nothing wrong with them. There's tons of bridge lenders out there. I want to be able to be, you know, less in a large market. And that was kind of the decision point of saying, I have to be able to say, what's that going to be for us so that we can be different, and also add a lot of value. And it's just a lot. I'm like to be creative and try things. So that was probably the reason behind it. Plus, naturally, I would say I'm a risk mitigation guy. It's just the way my brain works. So I just have to spend a lot of time modeling things to go, okay, what would happen here? And I'm asking all those tough questions. So it just checked all those boxes for me to just say, I feel comfortable that I would put my money in this, and that I have, and that I know we can pull it off. Or at least I'm super confident. I mean, there's never 100% sure, but so yeah, that would be the reason why we ended up doing that specifically.
Yeah, Dave, wanting to do something a little bit different, finding the opportunity. You mentioned that, hey, there used to be 15,000 banks. Now it's only 4,000. The other
Mhm.
options out there are starting to dry up, agency debt, CMBS. So having an option that is, less regulated, creates more flexibility for those investors who are looking for creative ways to get deals done. There's definitely an opportunity there, and investors are looking for those kind of options. You mentioned that you focus on risk mitigation. I think many listeners might hear 80 to 90% LTC, and the kind of gap or the basis point you want to see as far as the upside. And they would say, hey, that feels pretty risky, right? Maybe these guys are over leveraged. How do
Sure.
you manage risk when you're lending that much on a
Yeah.
deal?
It's a great question. It's one I've asked a lot. So the way your risk is a really fascinating thing because it's contextual, right? I mean, you can't throw all risk into one bucket. You almost have to isolate and start saying, what are the major risks versus the minor ones, and what do those look like? And you hear leverage, and you do say that's kind of risky. The answer is, yeah, it is. And it's, how do you deal with it? So for us, the way that we have dealt with it is a couple of ways. One is looking at those metrics that we feel like are most manageable, like I talked about, that, debt yield to cap rate spread, that value creation spread, is that really there? And have we stressed it? Have we gone through and said, like, okay, well, that sounds good to your assumptions there, but what happens if you stress those assumptions a little bit? I think the understanding the market really well, and where it is in the cycle of the market, and where you are positioned relative to whatever competition was in that market, is one of the things that we really look at to mitigate. And then we won't go above 80% loan to value, right? That's the key thing. There's a distinction between loan to cost and loan to value. We're coming into things that are going to be value creation oriented. And we believe that that is possible, and that it's really driven by a really good manager. I mean, if you look at somebody, you could give 10 people a business plan, but we know that one or two of them are going to actually pull it off, right? Because they have the gusto, the drive, the tenacity, the smarts. So you're looking for those good horses that are going to win the race. And that's part of the battle is, picking the right people. And then not only those people that know their stuff, but they have enough gray hair, so to speak, behind them to go, things don't always go as planned. So I've got some cushion in here just for that. So I think it's just kind of looking through all those elements, and every deal's different. That's why, my experience helps and the team does, because we can see things that through the years we're like, we got to think about that. And so I think it comes down to judgment, data, people, and ultimately there's a little bit of luck at the end of the day.
Dave, I
So
appreciate you sharing that, right? I mean, listen, there's some level of risk with every investment,
yeah,
and your job is to mitigate and manage that risk and recognize, what to do in certain situations. And that's part of why you have the process that you have. And,
yeah,
those are the things. And that's also why there's a gap in the marketplace, right? Their
yeah,
agency debt is not willing to take those risks, right? That's
yeah,
why they
for
have their
sure.
criteria, and they're going to
Yeah,
limit you to 60 or 65% LTV, and they're
yep,
going to limit you to a 1.25 DSCR, right? The debt service coverage ratio.
yep,
So that's why those lenders have that, and there's a gap or an opportunity for others who are willing to take on a little bit more risk as long as they can manage that. And that's exactly where you step into the place. For folks that want to learn more, they can check out your website, go to hybriddebtfund.com. You can learn
mhm.
more there. Right now, we're going to transition to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Dave, give me a failure or an apparent failure that sets you up for later success.
Yeah, I would say I love this concept of failure, because we always call it innovation comes out of frustration, right? Like, what did you learn? In fact, there was a study years ago about these guys. They interviewed all the executives and said, what was the one thing? They said reflection was the big help. So as I've reflected in my own life, I would say going through the 2008 timeframe, I mean, I just got hammered. I was young and I thought I'm smarter than I was, right? We took on more risk. I had some debt I shouldn't have had. The market just corrected and I got pummeled, which was really painful in the time, but it made me step back and say, okay, what did I learn from that? Well, number one, don't have a lot of bad debt, right? There's bad and good debt. And so just, having cushion and margin, because cycles just happen, I think was one of the lessons that I learned. And then just really having a lot of wisdom around you and talking to people with those wisdom on a lot, and listening more than you speak. I think those are some of the things that I've learned over. Every gray hair on my head has a story, but yeah, so.
Give me a technology or a digital resource that you would recommend for our listeners.
I would say one of the things that, I use ChatGPT every day. I love it. So that would be a given, which I'm pretty sure hopefully everybody's using. But the one thing that's been awesome is Podpitch. And it's an amazing technology tool that kind of helps you get on the podcast. And it's just been, it's an AI implemented thing that saved me hundreds on hundreds of hours. And I'm always looking at tech stuff, but that one's pretty cool.
Give me the book you've recommended or gifted the most in the last year.
Oh, I would say, gosh, there's so many, but I would say probably um, Atomic Habits are pretty awesome. And I use it all the time.
One of our favorite, Atomic Habits by James Clear. Awesome.
Yeah.
All right. Give me a daily habit that helps you stay focused on your goals.
Every single day, 7 days a week, I have a journal that I go through, and I do it for 10 minutes to 15 minutes a day. At the end of the day, I reflect, and it's the game changer. At the very end, I always say, what's the one thing I need to do to change? So I would say that time of reflection is probably one of the most imperative things that I do.
Give me your number one insight for launching a fund.
Oh, that's a great question. I would say I have this thing that I always go through, which is wisdom, plan, do. And just really spend a lot of time up front gentrifying your idea by talking to a lot of people that are ahead of you and down the road, and get all their insights before you act. So part of that is the wisdom, get the information, give it to people, let them poke into it, plan, and then the doing comes at the end.
I love it. Great stuff. Dave, are you in Scottsdale?
Yeah.
All right. So you're in Scottsdale. Give us your favorite place to grab a bite to eat.
I'm boring, but I would say True Food, partly because it's close to us, partly because my wife has celiac, so it's the only place we can go. But it's really good food. True Food's awesome.
True Foods it is. Good
Yeah,
stuff.
yeah.
A lot of great stuff today. Really enjoyed hearing a little bit about your background, coming from, the finance world and working in kind of the loan space, and just really all the relationships you built, and just recognizing that industry, 2 decades, working in the lending space, and then
Mhm.
developing the hybrid debt fund, recognize the need, the challenges that investors are facing, and talking to them to understand what did they need, what kind of solutions were out there, and crafting something that was a little bit different than what existed in the marketplace. I appreciate you sharing us both the back end of what it took to create the hybrid debt fund and getting investors on board, helping us understand that, hey, you've got to think about your channel, right? Who's your target audience? Who's going to invest in you and these ideas, not to mention the actual deals once you have them, and just giving us that framework of what it takes to go out there and build a successful business, particularly when it comes to creating a fund, but also recognizing that, hey, there's risk in everything you do, right? Risk
Mhm.
in all sorts of investments. Your job is to really mitigate those risks by understanding and recognizing those risks and separating small risk versus big risk that can really
Mhm.
derail the deal with the opportunity. Again, for folks that want to learn more, check out the website hybriddebtfund.com. And if you're interested in investing in apartments, make sure you check out our guide, 7 questions you must ask before
Mhm.
investing in apartments. It's available at casmancapital.com/7 questions. Great stuff, man. Dave, great having you on the show today. We look forward to staying in touch with you, and I hope you have a great rest of your day.